The silent hum of servers in a nondescript building, the subtle shift in a percentage point, a communique of carefully chosen words released to the world. These seemingly benign actions, often lost in the din of daily headlines, are the true levers of global power, emanating from institutions largely unknown to the average citizen. They are the central banks, unelected, yet wielding an authority that shapes the trajectory of nations, the fortunes of businesses, and the very fabric of our individual lives. They determine the value of your savings, the cost of your mortgage, and the stability of your job, all while operating in an intricate dance of economics and geopolitical influence, largely out of sight. \n for centuries, the concept of a singular entity managing a nation's money supply was an anomaly. Early forms emerged from pragmatic necessities, the funding of prolonged wars, like the Anglo-Dutch Wars, which necessitated large-scale, sustained borrowing beyond the capacity of individual merchants. In 1694, the Bank of England was founded, not as a public institution, but as a private corporation tasked with lending money to the government at interest, in exchange for the right to print banknotes. This marked a pivotal shift, establishing a template for a national bank that could stabilize currency and act as a lender of last resort, preventing cascading financial panics in an era prone to banking runs. Yet these early banks were often perceived with suspicion, their power seen as a threat to both monarchical authority and popular liberty. \n the 18th and 19th centuries saw a slow, often contentious, evolution. As industrialization spurred economic complexity, the need for a stable financial system became undeniable. The gold standard, adopted by many nations, offered a seemingly immutable anchor for currency value, tying money to a finite physical commodity. Central banks, where they existed, became custodians of these gold reserves, managing convertibility and striving for financial equilibrium. However, this system proved rigid, prone to boom and bust cycles, and inherently deflationary in periods of rapid economic expansion. Nations often found themselves unable to expand their money supply without increasing their gold reserves, leading to economic contractions that inflicted widespread hardship. \n the turn of the 20th century, particularly in the United States, saw repeated financial panics exposing the fragility of a decentralized banking system. The Panic of 1907, a severe banking crisis, served as a potent catalyst. Wealthy financiers like J.P. Morgan were forced to intervene personally to stabilize markets, underscoring the urgent need for a systematic solution. The Federal Reserve System was established in 1913, following years of intense debate and compromise, creating a decentralized central bank designed to provide an elastic currency, discount commercial paper, and supervise banks. It was a novel hybrid, intended to balance regional interests with national stability, a cautious concession to the immense power it would inevitably wield. \n the true test of these institutions came with the Great Depression of the 1930s. The Federal Reserve, still in its infancy, initially failed to grasp the severity of the crisis, allowing thousands of banks to collapse and the money supply to contract drastically. This catastrophic error in judgment, compounded by adherence to the gold standard, deepened and prolonged the economic downturn, plunging millions into destitution. The lessons learned were profound. Central banks had to be proactive, not reactive, in managing the money supply and acting decisively as a lender of last resort. This period forged a new understanding of their critical role in macroeconomic stability, cementing their responsibility to prevent such systemic failures. \n the aftermath of World War II saw a global redesign of the financial architecture. The Bretton Woods Agreement of 1944 established a system where the U.S. dollar was pegged to gold, and other major currencies were pegged to the dollar. This made the Federal Reserve the de facto central bank of the world, with its monetary policy resonating across continents. This era brought relative stability and fueled a period of unprecedented global growth, yet it also demonstrated the inherent tensions of a fixed exchange rate system. As U.S. spending on the Vietnam War and social programs grew, inflation became a problem, eventually forcing President Nixon to unilaterally abandon the dollar's convertibility to gold in 1971, ending the Bretton Woods system and ushering in an era of floating exchange rates. And the 1970s presented central banks with a new, formidable challenge. Stagflation, a toxic combination of high inflation and stagnant economic growth. Traditional economic models struggled to explain, let alone solve, this phenomenon. The Federal Reserve, under Chairman Paul Volcker, made a bold, painful decision. In 1979, Volcker dramatically raised interest rates, pushing the federal funds rate to nearly 20%. This draconian measure induced a severe recession, causing immense economic pain, but it effectively broke the back of inflation and reestablished the central bank's credibility as a guardian of price stability. This period marked a critical turning point, solidifying the modern central bank's primary mandate, controlling inflation, often through the powerful but unpopular tool of interest rate manipulation. \n As the global economy evolved, so too did the tools and influence of central banks. The late 20th and early 21st centuries saw a period of great moderation, characterized by stable growth and low inflation, often attributed to skillful monetary policy. However, this calm was shattered by the 2008 global financial crisis. Central banks around the world, most notably the Federal Reserve, the European Central Bank, and the Bank of England, responded with unprecedented force. They slashed interest rates to near zero, provided emergency liquidity to banks, and introduced novel policies like quantitative easing, purchasing trillions of dollars in government bonds and other assets to inject liquidity and stimulate lending. These actions, once unthinkable, prevented a total financial collapse, yet they also vastly expanded central bank balance sheets and blurred the lines between monetary and fiscal policy. And today, central banks stand at the zenith of their influence, yet face an increasingly complex and interconnected world. Their primary mandate remains price stability, but they are increasingly drawn into broader societal concerns. Climate change, for example, is now a topic of discussion within central bank boardrooms, as they consider the financial risks posed by extreme weather events and the transition to a greener economy. The rise of digital currencies, both private cryptocurrencies and potential central bank digital currencies, poses fundamental questions about the future of money and central banks' role in it. The specter of global pandemics, like COVID-19, has further demonstrated their crucial role as first responders in economic crises, rapidly deploying liquidity and support to stabilize markets and economies. The tools of a modern central bank are subtle yet potent. Setting benchmark interest rates, which dictate the cost of borrowing for individuals and businesses, conducting open market operations, buying or selling government securities to influence the money supply, implementing reserve requirements for banks, and offering forward guidance, communicating future policy intentions to steer market expectations. These mechanisms, while seemingly abstract, have tangible effects. A slight increase in interest rates can cool an overheating economy, but also make a mortgage unaffordable for a first-time homebuyer. A program of quantitative easing can stimulate investment, but also inflate asset prices, exacerbating wealth inequality. The delicate balance they must strike is immense, often pitting competing societal interests against each other. /n/and the rationale for central bank independence, a cornerstone of modern monetary policy, is rooted in the belief that political interference would lead to short-term electoral considerations overriding long-term economic stability. By being insulated from daily political pressures, central bankers are theoretically free to make tough, unpopular decisions necessary for price stability and economic health. Yet this independence also raises profound questions of accountability in democratic societies. Who truly governs the governors of our economy? Their power, derived from technocratic expertise and institutional design, shapes the future without direct electoral mandate, a silent force guiding the global economic currents. /n/n as we navigate an era of persistent inflation, geopolitical fragmentation, and technological disruption, the spotlight on central banks intensifies. Their decisions, once confined to obscure economic journals, now dominate headlines. They are tasked with threading the needle between curbing inflation and avoiding recession, between fostering growth and mitigating financial risks, all while maintaining credibility in a world increasingly skeptical of institutions. The hidden power of central banks is not just about controlling money, it is about managing expectations, guiding confidence, and ultimately steering the vast, often turbulent ship of the global